Good morning. It's March 30th, and this is Rich Posson for the Critical Point podcast. Let's talk about the stock market relative to the S&P 500 mini futures. We believe that back on March 23rd, the market placed short-term to perhaps even long-term bottoms. The model has suggested a wave of buyer interest for the L4 intra-week trend, seller interest, then buyer interest, and you can see it was broken up and choppy last week. Something was going on where we had a change of heart in players. That could be players that were looking more long-term, did not care what occurs intraday, intra-week. They just went in and did some buying and selling, okay, and just didn't pay attention to whether they're getting the best price or not. They had to take action. Now, some of this could have also had to do with the voting on the $2 trillion deal on the government side of dealing with the virus impact to the U.S. economy. At any rate, we believe there was an L4 top on March 27th. The trend was to be down into a bottom due no earlier than, say, 10 a.m. Eastern Time today. Now we think the market bottoms during the first half today for this L4 trend, and we should see the market higher tomorrow, and it may stay higher into Wednesday before the next L4 setback. Now, there is a possibility that the L4 trend will extend by one additional L5, which is more of an intraday swing. Therefore, the market doesn't have to bottom until late today. It could stay down for the day. But we're watching for signs of a positive reversal, and we think the market will be higher by tomorrow. And so now let's take a look at the daily chart and get an idea of the monthly up and down trends, the level 3. Those level 4s we just discussed were basically just pops and drops every few days along the trend of the level 3. And we, as said, March 23rd, we assume a level 3 bottoms in place. Now, the problem is it really didn't complete the correct number of level 4s inside of it. If the market were to become quite weak this week, we would assume it's just wrapping up a rather strange, broken up level 3 pattern, and we would still call for a level 3. In other words, we would move this level 3 from March 23rd into a low this week, and we would still call for a higher price over time here. For the moment, we assume the market just did something strange, that suddenly people just said, we've sold enough, we're done. And this is the level 3 bottom, and again, it may actually be even a long-term bottom. So we think the market is just hesitating here within a developing uptrend that's going to last into April 2nd. So we still see a chance here for a variety of days. So we see the possibility that we'll see more buyer interest and seller interest for the next 3 to 5, perhaps 6, 7 days. Upside potential has been slightly changed. We're now up to 2682 or so for the lower side, and this is the futures, not the cash, but they should be fairly close. The midpoint, if you want a single price target, might be the low 2800s, 2818 or so, and there is potential to go to, say, 2919, and then you have this band of 50-day to 200-day moving averages that should be strong resistance, but probably on a temporary basis. The market is overall bought on a short-term basis for this stochastic indicator warning. It may be a struggle to move higher into these upside targets and to stay up into the time target, which is basically saying look for a top April 2nd to maybe April 5th, possibly one day later. So the short-term forecast is that the news cycle is at least going to be a little less bearish, kind of old news, status quo, or maybe we're even going to see a little bit of something positive coming here. And again, it could be primarily short covering and technical, so really don't necessarily have to have the news development to put this market higher. Let's go ahead and flip out to the next larger trend. So now this is the weekly chart, so we can zoom out and see the level 2, level 1s, which are minor, major, intermediate, but intra-year trends. They're most important trends you're going to see during a year. So what we believe is the market top for level 1 and long-term cycles. We've had a long-term bear market that may have ended in just 2 months, perhaps the shortest on record. We don't know that for sure. There are many opportunities to place a long-term bottom now into next year being the latest year for a long-term bottom. Currently, we're going with the best forecast as a rare occurrence of 2 level 2s between 2 level 1s. We have called a level 1 bottom as of last week. We believe the trend is up into week of April 13th. We now think it'll be over by April 27th, but we're leaving the original target that it could stay up into week of May 4th. That will be a level 2 top, and the market should retrace into a level 2 low and then head higher into summer. Now, the problem with this is it's possible that the late January low was actually a level 1. That would make last week's low a level 2, and this would suggest that we won't have quite as robust rally, but the market should still move up over the next few weeks, and then it should move down to test this low and ideally go to a new low for the year. And both of those scenarios are suggesting a level 2 or level 1 bottom as of week of May 18th to week of June 15th. Now, the reason there's 2 different scenarios is that the market is considering what if we get a continuation of bearish information out of this virus and the impact on the economy all the way into, say, May, versus maybe this virus peaks in just the next couple of weeks and we become more optimistic. The market doesn't know which way to go with this, and it's showing both scenarios, and rightly so, because this data could be flaky or it could remain in a strong trend, and we're just going to have to go along with this and see what occurs by May. Hopefully we'll have greater insight before we actually get to that May bottom so that we can tell whether or not we're still in a long-term bear market. Current best forecast today is we think we've got a long-term bull market underway. At any rate, we suggest that the market should rally over the next 2 weeks at least, and maybe 4 weeks, and it could even be 5 weeks, but we're have again reduced the amount of time to rally here. Now, we got this rally last week. It should go a little higher this week, but next week should be that L3 pullback, but it should be minor if indeed it's going higher into this time price zone. Now we have an oversold stochastic, weekly stochastic. It is turning bullish. It's not wide enough spread yet to consider lingering momentum, but overall we're taking it at face value that it's backing up the model outlook, meaning we think the technical picture is backing up the business cycle, that for some reason or another, there's going to be more buyer interest, if not outright demand, than supply in the next few weeks. And again, upside objectives range anywhere from 2600s to 2900s for the S&P. And so this is the monthly chart now. So these level 1s now look like pop and drops within long-term trends. We believe the market just placed a 3-year cycle bottom, therefore a 9-year cycle bottom as well, because the 9-year is due now. We need only a single 3-year bottom to trigger the 9-year. If it has bottom long-term for the 9-year, then it's a bull market into 2028 to 2031 when we would see a peak and a recession, a primary recession. It is possible to peak 2027. That's the earliest relative to just the 9-year cycle by itself, but the model has thrown that year out at this time. Okay, then 3-year cycle would then be up into 2022, and then we would have some kind of throttling back in the economy and the market. Now, the risk is that this 9-year cycle that began back here in 2009 and had a sequence of supply and demand for 3-year cycles. The risk is that the last 3-year cycle did not bottom early 2018, it bottomed late 2018, and we are too soon. It cannot or should not bottom now. The earliest would be November under that scenario, and the latest is the bottom sometime in 2021, same as our forecast for the economy, that ideally the economy bottoms no later than 2021. So there could be multiple opportunities here to have a long-term bottom, and it may not be the fact that the model can't forecast which one it will trigger the bottom. It's that the data can change and people can simply just change their mind. They could be bullish and we could be looking clever and then all of a sudden they turn negative and bearish, and we have to start over again. So currently our risk point is the low of this year. Notice that the market has rebounded to a former trend line of support of 3-year cycles, a very nice trend line that worked well. And this could be resistance now. It might bump its head and have to pull back, especially if we're making a mistake that it really didn't bottom long term. But what if it rallies well above it up towards 3,000 here in coming months? Then this line would become support or become useless. Bottom line is we've already established a long-term support line through the low of this year, and our thoughts are even if the long-term cycle does not bottom now, and it's going to bottom later to much later, there is the possibility the lowest price for this index occurs now, and the long-term bottom occurs at somewhat higher price further down the road. So the best we can say is we're taking a chance here, perhaps with high risk of being early, perhaps even still high risk in terms of how low price can go. But ultimately, we're giving the bulls a chance here. We like a scenario of having some long-term intermediate positions here and a bit of diversification. At any rate, I hope this has been helpful. Manage your risk relative to the analysis of others. Thank you.